It's now my pleasure to introduce Alan Clement. Now, Alan's been a fixture and a feature of Victorian ATAA and one of our most entertaining speakers. So it's with great pleasure that I introduce Alan to you. And Alan's going to go through his quarterly market update. He's, with a bit of luck, he's going to go a bit more in depth to it. So please make Alan very welcome, one of our best systematic traders around. Thank you, Alan.
Thank you. Welcome, everyone. Yes, well, it is time for the quarterly technical outlook that I tend to do once a quarter to look at where we are in the markets, where we might be heading in the next weeks and months to come. Just before we get there, though, I just wanted to remind everyone that we've got the conference coming up next week. In fact, 1 week tomorrow. 1 week on Saturday. It's here in Melbourne at the Mantra on Russell Street in the city. We've got a great lineup of speakers. If you've never been to one of these before, I would highly recommend it. Much more information on the website. If you just Google ATAA conference or just jump on the ATAA website, you'll see all the information about the speakers and the timetable and what have you. And we've already got a lot of people coming already. So if you do still want to book, I would suggest you get in quickly because there's only a few spots left. If you can't make it, you still want to attend, there's always the live stream option as well, which will be running all weekend. So more information at ataa.asn.au. So yes, onto the global markets technical outlook for the end of Q3 of 2025. Everything you're about to see in here is just general information in nature. Nothing is a recommendation to buy or sell any financial instrument. Please do your own homework and make your own decisions. We always kick off with the US stock market, still the biggest stock market in the world, tends to drive all the other stock markets, so it's good to know where it's heading. And on a log chart, it's heading from the bottom left to the top right, and continues to do so. So you can see the trend is still very well behaved. There's no steep rise in volatility that you would generally expect to see with some large top forming, not yet anyway. With that said, we've gone through that 6,000 level. We're heading towards 7,000. We're at 6,700 and change at the moment. It's starting to look a little bit overbought to the upside, you'd have to say, just a little bit overextended. However, we have come out, on this time frame, this is a monthly chart, we have come out of that corrective phase through the Liberation Day tariffs back in April. So that's kind of taken a lot of the steam out of the market and then brought some fresh money coming in from the sidelines, and that's what pushing it up. Obviously, the whole AI narrative is generally what's been driving this market ever higher. There's large growth stocks. The Mag 7 are the ones that hold that make up about 23% or so of the S&P 500 at the moment, which is a lot, and explain almost all the upside that we're seeing. If you look at the other 493 stocks, they're near enough flat or down. So it's obviously looking a little bit top heavy, you could say. We're starting to see shrinking participation, as you'll see in a minute. All of that means that there will be a correction at some point down the track. When we don't know, but just keep that at the back of your mind as this market goes ever higher. If we zoom into the weekly chart, you can see that breakout across that old 6,100-ish level there, and it's really just taken off like a rocket. It's not often that you see a stock index doing this sort of almost parabolic type of move. It's starting to look like one of those little altcoins a little bit, in fact. But you can see it's just starting to look like it's losing a little bit of steam at the top there. Just the bars are just getting a little bit smaller. And with the size of this with this magnitude of breakup, we would normally expect it to come back and retest that breakout line as it did below at that sort of 4,500 level there. So that's probably on the cards at some time down the track, and just again be aware of that in the back of your mind. But with such a strong market, as you might expect, the Ichimoku chart's looking very bullish at the moment. The price and the Chiku span, or lagging line, that green line there, both above the cloud, that tells us it's indisputably bullish. And then we look for support around the cloud. You can see how the cloud provided near picture perfect support when we got that Liberation Day sell-off, and the cloud now forming support around about 5,500 there on the chart. So if we did get, I mean, that's a long way back from where we are now, but if we did get back into that vicinity, we would expect some demand to show up around about there. So it's all looking very bullish on the price charts. The question is, how well is that being supported behind the scenes? So we'll take a look now at the what I call the market internals, and just seeing what's happening under the bonnet, as it were. So firstly, to the bullish percent index, this measures the percentage of stocks in the S&P 500 that are bullish, that are displaying bullish patterns. And you can see there we're sitting at 59%, which is a lowish number considering that we're actually at all-time highs right now. And you can see that the peaks in this chart have been getting lower. Now, that's not unusual for such a mature bull market that we've been in. You would expect to see some divergence as the market moves higher. Generally, the participation will shrink, and that's exactly what we're seeing on this chart. At some point, that will shrink to a stage that's no longer sustainable, and the market will reverse. Are we there yet? Who knows? But on this basis, I mean, if you look at these bullish percent charts historically, these divergences can last for very long periods, 10, 12, 14 months before the market decides to crack. So given that we've been in this one for coming up for 12 months now, we're probably getting towards that stage. Another way to cut that same piece of information is to look at the number of stocks currently trading above their 200-day moving average, or sorry, the percentage, I should say, which is currently around about 65, which is sort of okay, but you would certainly expect it to be higher with the market making new all-time highs just about every week at the moment. But once again, you can see that type A type divergence just starting to creep in there as the peaks seem to be coming in a little bit lower each time. Again, indicating that shrinkage in participation of the up move. However, it's not all bad news. If we look at the discretionary versus staples, which is often a leading indicator of where the broader market is going to go, you can see that it's actually made a higher peak recently. I mean, some of these charts are bewildering when you think about what we're seeing in the news and the way the state of the economy in these US especially is getting kicked around politically with tariffs and various other things. People are still out spending. It's just bewildering, but there it is. Nevertheless, on a technical basis, what this means is there's no divergence between the discretionaries and staples ratio and the S&P 500. So that's a tick in the box for the bull market. The other one is semiconductors. Probably no surprise that they're making new highs. This is semiconductors versus the S&P 500 at the top there. Obviously, all tied up in the big AI story. A lot of these AI companies can't get their hands on enough these chips, and the chip makers can't produce them fast enough. Tie that in with almost all the chips are made in one factory in Taiwan. It's a huge risk for the industry should anything happen to that supply chain. But nevertheless, that's not being reflected in the price at the moment. And once again, that's a tick in the box for the broader market because the semiconductors will tend to pull the broader market up. Same on the advanced decline line. So the amount of stocks advancing are still outpacing the ones declining. And again, that tends to be bullish for the market. You can see making new highs and the market also making new highs. So no divergence there as well. So it's certainly not a broad picture of things deteriorating. Things are still looking very, very strong across the board. And we're only just seeing a couple of spots where things are starting to deteriorate a little bit. If we look at the picture year to date, you can see that reflective of this AI tech stock, growth stock, narrative that Nasdaq 100 in particular is leading the charge. It's up 18% for the year so far. That's about double what you would expect on a long-term basis. So it'd be interesting to see whether we still are up at these levels or even higher towards the end of the year, or whether we see it sort of drift down towards something a little bit more reasonable for the full year. Question.
I saw on telly the other day. I saw on telly the other day that the Russell 2000 was out in the last month and a half. I think it has been outperforming the other indexes by about. It's been outperforming it by about twice as much.
Right.
So,
well, I think you can pick that up on that chart. You can see how it's narrowing the gap between the other two big indexes, which is interesting. Yeah,
which doesn't seem to correlate with what you're saying, where it's only a few stocks that have been driving the market.
Indeed, yeah, that's right, and which is why I'm saying that the picture's not uniform. It's a little bit patchy about the information. So yes, it's a good point that the small caps, which is what the Russell 2000 is made up of, they also tend to be leading indicators, because they're effectively the incubators of the economy, which is why it's perplexing that a lot of these stocks are doing very well given the market conditions that they're facing over there in the broader economy. But nevertheless, you make a good point that the Russell is catching up to the other two, and the gap is narrowing between those three indexes. And the fact that they're all up by double digits year to date is quite phenomenal. And again, it just makes you wonder whether we'll still be in this situation by the time we get to the year end. Over now to the yield curve. If you're not familiar with the yield curve, this measures the level of yield that you get on your bonds, your treasury bonds of various maturities, with very short dated maturities on the left, very long dated maturities on the right. And generally what you want to see is the shape that the curve's in now, which is the so-called normal shape, meaning that you get less yield for having your money on loan to the government for a very short period, and you get much more because you're taking on more risk out into the future. So this is good. This is a good sign that we're in this shape at the moment. It generally means we're in a low risk period, and it's generally good for the stock market because the returns are lower in the bond market. That will tend to funnel money out and rotate it into the more riskier stock market in the so-called hunt for yield. However, you can see of those the shadow lines there where the yield curve has been, and it's actually not moved around that much lately. The short end of the curve has started to move down a little bit because we're seeing the cash rate falling, the Fed's funds rate. The Federal Reserve just cut rates last month. There's a question mark about whether they might or might not do that again, but you can see the short end of the curve just falling a little bit there. Meanwhile, the rest of the curve stable. However, getting to this shape actually came from being in another shape, which is the so-called inverted shape, which is high on the left, low on the right. That's where you're getting much more for holding your money short term than you are long term, and that's called an inversion. You can see it on this chart here, which looks at the spread between the 10-year bond and the 3-month bond. So you're looking at the sort of left-hand period of that yield curve, if you like, where you see the spread below that thick horizontal line, which is the zero line. That was the period we were in the inversion, all the way from basically 2023 until the start of this year. And why is that significant? Well, once you've been in an inversion of the yield curve and it flicks back the other way, that's almost always a precursor to a recession in the broader economy. And you can pick that up on this chart. Confusingly, this is the other way up. So the inversions are shown above in that pink area, and then when it pops down again, we're back into that normal shaped curve. The red dashed line being the zero line. So you can see almost every time where the spreads popped up and then dropped back down, there is like a time gap, and then you get those vertical shaded areas, which are the recessionary periods. So you can see it's a very reliable indicator. In almost every instance, it's been the forerunner to a recession. Even in 2020, when we got the COVID recession, What's interesting now is where we are right now, which is we've been in that inverted period. We're now back in that normal shaped curve, which means there's a very high probability that we'll see a US recession sometime in the next 12 to 18 months. So we're in that period at the moment, and when it will come, we obviously don't know exactly. But again, it's been a reliable indicator historically. Looking at some other sentiment indicators now, this is the put-call ratio, which measures the number of put-call ratios in relation to the number of the number of put contracts to the number of call contracts in the market. Obviously, when there's more call contracts open, people are more bullish, and vice versa. And what we can see here is that now this indicator is inversely correlated with the stock market. So when it's down here in the lower extreme, that tells us that there is an overly bullish sentiment in the market. There are many more call holders than there are put holders. People generally buy put options, well, especially on the institutional side, put options are used as portfolio insurance. So we're not seeing very much demand for portfolio insurance, meaning that money managers generally think that risk is low in the market. Meanwhile, there's a lot of people chasing the upside by buying call contracts at the moment. So that large imbalance, which is almost 2 to 1, we're sitting down about 0.5, which means for every put contract, there's actually 2 call contracts open currently. And what tends to happen is when we get to the extreme and everybody's on one side of the trade and there's nobody left to buy, well, then the market will tend to reverse. And that's why it's called bullish extreme down at the bottom there. So we are getting to some point which you would expect to precipitate some sort of inflection of the market back to the downside. Of course, the timing is the big question. If you just look at the put-call ratio on 5-day average, which is what that top indicator is showing, you can see how well when it gets down to that 0.5 level, that is often a place where we get a turn in the market from the upside, so a turn from going up to going down. And you can see right at the very end of the chart, we're right at the same spot now. So again, it just does indicate that we're maybe getting close to some sort of at least short-term top in the market. On the VIX, the volatility index, so this tends to run in these 3 zones: low risk, elevated risk, and high risk. The 2 big spikes there that you can see is the Bank of Japan's rate decision back in August last year, and then the so-called Liberation Day announcements of the tariffs in April this year, which caused a huge amount of volatility initially, and now it's basically all priced in. People are used to the chaos now, and it's just part of the overall landscape, if you like. So the market is heading up. Risk is low. Generally, the VIX will pop when. So the VIX, as you probably know, is priced by looking at S&P 500 options. So again, it's a form of portfolio insurance. People buying put options, or you can actually buy futures on the VIX. So when those sorts of things are in demand, because the market looks like it's about to collapse, the VIX will tend to shoot up in price. We're obviously not seeing that. So again, market participants are generally very, very sanguine about where we are at the moment. Of course, bear in mind, the VIX is a mean reverting index. When it gets very low, it will tend to spike up. When it gets very high, it will tend to spike down. So it's not going to remain this low forever, but at the moment, it's reasonably low. And it's probably worth saying it's not the lowest it's been even in this little short piece of history. We have seen it further down below 12 points in the past. So volatility is not super low at the moment, but it's not high by any means either. The CNN Fear and Greed Index is a composite indicator that takes about 5 or 6 different sentiment indicators and just comes out with a number between 1 and 100 about where sentiment currently sits. And you can see there that it's right in the middle. It's very neutral at the moment. In the top left-hand corner is where it was the last quarter when I did this last time at the end of June. And you can see it's gone from being in extreme greed to being very neutral. The time series is at the bottom there, and you can see how it's come down from being overbought, if you like, down to a bit more manageable levels. Why is that? Well, one of the inputs it uses is market breadth, and so from those charts you saw earlier, the market breadth has been falling, and that has been feeding into this indicator and making it look less extreme at the moment. So make of that what you will. So with all that sort of conflicting information and things pointing in different directions, I thought I'd revive a little occasional series I do called Where to From Here, where we can have a look at various other little indicators and see if there's anything we can pick up. So the first, this one caught my eye because stocks are very expensive at the moment. So this is looking at the forward PE ratios relative to the last 20 years. So the little orange diamond is where we are now in terms of valuation, and then the vertical bars are the showing the data from the last 20 years. And you can see in almost every sector we're way above the 90th percentile in terms of valuation. Question.
Ratios, are they inflation adjusted or are they just looking at the PE ratios?
That's a good question. It's Goldman Sachs's chart, so you'd have to ask them. Yeah. Yeah. I mean, from my point of view, the interesting part is that we're sitting very near the top of the range. And those, that level of valuation is not going to last forever. Eventually, we're going to have to mean revert back into the middle of the data somewhere. So in other words, if you're buying stocks to hold long term at the moment, just be aware that they're quite expensive at the moment. This is another way to cut that same data. The sort of chart on the left there kind of shows what I've just shown in another format. The one on the right here is interesting as well, though. This is the price to book value, and you can see that the world and the USA both outstripping that long-term average of about 2.8 as well. So again, just indicating that we are very expensive to the upside at the moment. Just jumping back to the yield curve as well, we are getting this steepening of the curve. So the 2-year versus the 30-year yield spread at the bottom there, just showing that curve is starting to steepen. And if we look back from to the past to where we've come out of an inversion and then steepened and gone through that level of about 1, it's a very small sample size, but it's uncanny what's happened to the market when those times have occurred. So 2001 was the internet bubble burst, or the tech wreck. And then 2007-8, of course, was the financial crisis. And as you can see here, we are approaching that same sort of vicinity now. So that's another chink in the armor, if you like, of the uptrend. And the other thing to say, just again on that AI narrative, is that most of what's holding up the US economy at the moment is the spending that's being done by these large AI tech companies. They're building out massive data centers. They're spending billions on high-grade chips that they can use to train their models. They're spending a lot on talent to program and come up with these AI models. Meanwhile, hardly any of them can make a profit. None of these companies are profitable yet. So how long can that continue? There's only going to be so much venture capital money that's going to be pumped into these before somebody decides the game is up. And if you take out all of that spending that's going on in that sector at the moment, we would probably already be in a recession. So that just goes to show that all the indicators showing that we should be probably moving into a recession are being held up by this unusual spending event that we're seeing right at the moment. The other thing that caught my eye was the home builders, which have been, well, you could call that a massive divergence. The home builders versus the S&P 500 has been, well, it made its peak back in sort of the last quarter of last year, and it's been in a steep decline since then. Why is that significant? Well, the home builders index is often the canary in the coal mine ahead of ahead of a more general downturn in the market, because those are the first ones to experience increase in construction costs, increase in labor costs, developers going out of business and so on. And perhaps we're starting to see that now. And why is that significant? Well, because the other piece of data that's interesting is the US home sales, which are accelerating, as you can see there. And if you go back and look at the last time this happened, 2006, which should ring alarm bells as well, because that was just a year before the market collapsed in 2007. And so why is all that real estate information significant? Well, because of where we are sitting in the so-called real estate cycle. There's an 18 or 18.5 year real estate cycle. And where we are now is in the very tail end of what's called the winner's curse phase, which the last time that happened was 2007. 18 years on that gives you 2025, which means that we should be coming into some sort of cycle peak in 2026 for real estate. Of course, if we see a collapse in the real estate market, that's going to eke out into the rest of the broader economy in general, and also into the stock market itself as well. So good one to have on your radar, that one. And we'll also have Phil Anderson at the conference next week, who is a guru on this stuff. So I'm going to be very interested to see what he's got to say. On the seasonality, so this is the annual seasonality of the S&P 500. We've got the year to date at the bottom there. And you can see that the low in the market came about a month after the low in the cycle was forecasting. And since then, it's just been one-way traffic all the way up for the market. So the question is, well, there's a lot of questions, but the main question is, why is there a disconnect between what we're seeing in the market and what we're seeing in the cycle? Obviously, the cycle expects a very flat market through that northern summer period, and then a correction into September, October. We got none of that, well, not so far. And so, given that the market is leading the or behind the cycle, I suppose you should say, does that mean that general correction that we would expect in September, October is maybe going to be delayed, and we get it perhaps in towards the end of October or even into November? But we are entering one of the most bullish times of the month. The last quarter, as you can see there from this chart.
Times of the year.
Time of the year. Yep. October, November, December are as a group, the three most bullish months of the year. Santa Claus Rally is a well-known seasonal effect coming in towards the end of the year. So whether that will hold up this year or not, given that we are already up massively, will be very interesting to see. And the presidential cycle, which is a 4-year cycle, we're obviously in the so-called post-election year at the moment. The market also seems to be running behind the cycle here as well. So again, we got that low in the market in April. The cycle was forecasting it a little bit earlier, and we didn't get the peak that was expected in around about August or September there. Yes, it's probably more like August. So it does make you wonder whether, if the market is running behind the cycle, whether we get that peak a little bit later, which would put it towards, if you could take the angle of that line and just project it down, you're looking towards the end of October into November for the market to peak. And if we zoom out a little bit more to the big picture of the presidential cycle, and we see all 4 lines, all 4 years lined up, the black line being the cycle and the red line being the current market, you can see that we've probably had the best of what the cycle's got to offer up to this point. And next year, which is the midterm election year, the market tends to go more sideways. And so perhaps we're, given how bullish the market's been, maybe it does take a pause and have a little bit of a rest into next year, and we get that dip down in towards the midterm elections, which are the back end of next year, and then from there the cycle has us moving up from there. A quiet year next year would also line up with what the decade cycle is saying. So year 5 is the most bullish year. Nobody expected it at the start of this year, but that's certainly what we've had. And going into next year, again, does look like it's going to be a little bit more quieter if the cycle holds up. Anyway. So very bullish for the US stock market, but also a little bit mixed picture in spots, and a little bit a few signs that we're starting to look a little bit overbought to the upside. On to the Australian stock market on a monthly chart. Well, we're almost at 9,000. Can you believe that? I mean, even just a few months ago, that would be hard to believe. But we're flirting with 9,000 at the moment. Getting above 9,000 would be a huge achievement in terms of a psychological barrier. That means that 10,000 wouldn't be too far away. There's a lot of momentum behind this move, as you can see off the bottom of that. That spike candle there, about 7 or 8 back, is that low from the Liberation Day tariff move. Came out of that and just moved up like a rocket, and now just nudging against that 9,000 level. So looking very bullish for the ASX 200. Although it is also worth saying that it is also starting to look a little bit overbought to the upside. Zooming into the weekly chart, you can see that a little bit clearer there. You can see that 7,600 level, which was a key level for a long time, acted resistance, resistance, resistance. The market then got above it, and then it became support, support. And now it's left that zone, and it's moved up and broken out through that old high. If it can't get enough demand to get above 9,000, you would expect probably to come back and retest that old peak here. But if it can get above 9,000, then 9,000 becomes the new level of support. So let's see if there's enough steam left in the market, and that the US market doesn't catch a cold before then. Again, with the market this bullish, it's worth the Ichimoku chart is bound to look bullish, and it surely does. It's way up there, well above the cloud, and the cloud support sitting around about that 7,900 level. Also worth just pointing out that Liberation Day low there, where it just caught the bottom of the cloud. So always a good chart to have a look at if if the market's coming back towards it. You can often find some good buy points with it. Looking at the Aussie 200 versus a handbag of other indexes, and it's the Hang Seng in the Asian markets that's leading the charge. It's up 34% for the year. Can you believe that? That's a huge gain for any stock index. And then the Nikkei is looking not too shabby at about 20% there as well. Then we've got the S&P 500 we've discussed. And then under that, we've got the ASX 200, which is only up about 8% for the year. Feels like it should be much more given the charts we've just looked at. And the Nifty, the Indian Nifty, just coming in around about 5% for the year. Excuse me. On to the currencies now, and the US dollar. Well, the US dollar is weakening. It's back below that 100 level. 100 is obviously a key level psychologically on the US dollar index. And we're seeing falling federal funds rate in the US. That's obviously having a weakening effect on the dollar. All the chaos, the tariffs and what have you, also feeding into that same thing. And yeah, there's a lot of investment that was sitting in the dollar and US treasuries that's basically looking for another home at the moment. But nevertheless, whilst we have spent 2 or 3 months below that 100 level, we should probably take it in the context of this much larger range that we're in, between about 90 and 110. And we've basically not moved anywhere near moving outside of that range. So now we're below that 100. Maybe we expect it to consolidate in that 90 area. If we see another rate cut in the US, then we would expect this to fall further. And a weakening US dollar tends to help all the other majors, because that's who their major cross is. The Aussie dollar, of course, doing a little bit better than it had been. It's tested that 60-cent level. It now seems to be moving back up towards that 70 level again. It's not got a lot of momentum behind it, but the trend for now, at least based on the last few months, is up for the Aussie dollar. The euro is making the most hay out of the weakening dollar. As you can see there, it's bounced off that 105 level, which was a key level, and it's making another go at that 125 level. It's out of this descending triangle pattern, but it's not really made much headway to the upside. It's just kind of drifting more to the side at the moment. So, but certainly bullish for the euro at the moment. British pounds in a similar situation, or maybe just a little bit weaker, just very much sideways between that $1.20 and $1.45 area. And the Japanese yen is looking a little bit bearish once again. It had a good couple of months when we got that rate announcement last year from the Bank of Japan, but that seems to have just dissipated a little bit, and it looks like we're maybe headed for another retest of that $0.0062 to the yen. Bitcoin, of course, is the big story at the moment because it's making all-time highs again. So it's, on a technical basis, that 109.50 was the key level for it. That acted as resistance about 3 times, really, and then it finally managed to get above that, came back classically, retested it. That was the buy point, of course, that 109.50, and now it's up at $123,000 per Bitcoin. Rounding off on the commodities and looking at the crude oil. Well, crude's been weakening. We've got this kind of descending triangle pattern that we've been under for a very, very long period of time, years, in fact. And just lately, we got the break to the downside, hit that 55 level, but then bounced back up into the pattern. But it wasn't to last, and it's kind of just trickled down again. So it spent 4 or 5 candles under that 64 level, though. So you would have to sort of favor the 55 area rather than getting back above the 64 level at this stage. Wheat's been dropping as well, and this goes for soybeans as well, which I don't have the chart for, but I had a look at. So obviously we got that massive spike when the war kicked off in Ukraine, but a lot of the supply issues have been solved since then, and people are less worried about where their wheat's coming from these days. So that's going to be good news for food prices. Copper has been in the news as well because it was also making new all-time highs. It got above that $465 per pound area, and it made a massive spike higher. It's just come off a little bit, but it's still looking very bullish. Obviously, copper, big story in the green tech revolution, as well as many other things used in car production and various home building and various other things. But it was kind of languishing in this large sideways pattern after the breakout there, but it now looks like it's got some legs and it may move to the upside. Iron ore just looking a little bit lackluster at the moment. It's also got that little bit of a descending triangle pattern, obviously tied up in the whole China slowdown narrative as well. And that 100 level has been a key level going way back even before the left-hand side of this chart. And you can see it's flirted with that. It's wobbled up and wobbled down through it a few times. It's back above it at the moment. But I think the days of $140, $150 for iron ore are probably behind us now for the most part. And always, of course, saving the best to the last, which is gold. And unless you've been living under a rock, you'll know that it hit 4,000 this week, which is a huge achievement. I thought I'd leave it on an arithmetic chart just to show the scale of that move, because it's quite astounding, really, in just a matter of months, really. End of 2023, I think, was the breakout. Yep. And so, yeah, just a couple of short years, it's just gone off like a rocket. Obviously, there's a huge amount of reasons for this. I'm sure you've probably all got your own pet favorite. But on a technical term, I mean, if you had to look up the dictionary to see what overbought meant, I think this would probably be in there. Can
we quote you on that?
I certainly wouldn't want to be a buyer at these prices, let's put it that way. And when a market goes parabolic like this, it doesn't then just tend to go sideways at the end. We usually get some large move to the downside It's going to be a volatile pullback, let's say, and you don't want to be the one left holding the baby, as it were. So, but if you've held gold all the way up here, very good luck to you. I tip my hat to you. So just to summarize that, US stocks, we're seeing US stocks making all-time highs, but almost week by week at the moment. But we're just starting to see a few signs that maybe we're getting to some sort of climax in the market. Just a few things starting to look a little bit rocky. Meanwhile, it goes up. It could go up for another 3 months, 6 months, who knows? But it should just be aware of that as you participate in this market. But we're probably near the end than the beginning. The Aussie 200, of course, kicking its head up against that 9,000 level, and who knows, it could get above that and make a run for 10,000 before it's done and dusted. That would be interesting to see. And on the currencies, of course, that weakening US dollar helping all the other majors, but Bitcoin, of course, is the big story, which is making new all-time highs. And on the commodities, well, oil and iron ore looking weaker, copper looking very bullish, and gold heading for the moon. So I wish you good luck and good trading, and thank you very much for your time. If you're interested in revisiting this, it'll be on my Helix Trader YouTube channel probably later tonight. But with that, thanks very much for your attention, and bye for now.
Any questions online? Any questions?
Yeah.
Alan, do you find it amazing that the US government has been closed down for about 5 days now? In the past, just the thought of it closing down was enough to send the market, coming down, and now it's been down for so long, and the market's still making all-time highs.
I heard someone the other day say that we're in the Wile E. Coyote phase of the market, where you just run off the end of the cliff, but the gravity hasn't started taking an effect yet. So I think that's what's happening. To answer your question, I think a lot of that's priced in. A lot of people were expecting the government shutdown, so it's priced into the market. As you well know, what the market hates more than anything is uncertainty. That's why, even though the tariffs are up and down, people are just expecting that there's going to be tariff news one day or another. Whereas prior to April, we didn't know that. And so as long as we've got certainty, we'll see the market go up. As soon as things are looking very uncertain, then we'll see the market come down.
How are your investments going with your systematic trading?
Very well, yeah. I mean, a lot of my strategies are so the trend following strategies are doing well, obviously, because the market's going up. The things like mean reversion tend to do quite well in most types of markets, and then things like seasonality and stuff are all non-correlated as well. So I think the goal is, well, my goal is to get a portfolio of uncorrelated strategies and trade them together with the same capital, and that way you get a much smoother outcome, and you're not too concerned about the market direction in that case. Yeah. Yes.
So I just wanted to ask you, so I just wanted to ask about some of the data. I guess you showed the home builders index and the number of, is that stuff like taking into account like the population increases as well over those years? Or is it just a raw increase in homes built?
So the home builders is it's a sector index, so it has a collection of home building stocks in it, and it's basically just the average of those stocks.
I mean the graph you showed after, I think it was a number of new dwellings built.
There's the number of homes being sold.
Yeah, is that like per capita or anything like that?
I don't know. I mean, it's a US chart. So yes, whatever's been had, their population's shrinking at the moment, isn't it? They're kicking loads of people out. Yeah.
And then I guess the other thing is, have you looked at looking at the market adjusted for the downturn in the dollar as well? Like if the returns are as, I guess, extraordinary, looking at that sort of side?
That's a good question, actually. It's an interesting study to do, is to look at the index divided by the dollar. Yeah, and you'll see a radically different picture. I haven't done that analysis lately, but that's always an interesting one to do. Yeah.
Thank you.
Yeah.
Alan, you showed a few different seasonality charts, and some of them told a different picture to the other ones. Which ones are more dominant, if you like? Which they're more important than some of the others? I mean, some of them are quite striking as to what happens, like in the latter part of the year, like the Santa Claus rally and so on. Is there any particular one that's more important than the others?
I don't know. Your guess is as good as mine. I mean, my view with cycle charts is that they can, at best, they can be a guide. They're there's a lot of factors that are going to act on the market that will mean that they will either outperform or underperform the cycle. So I don't really have a particular favorite. In the past, I could probably say maybe the presidential cycle's been one of the more reliable ones. Yeah, but outside of that, I think it's like it's a lucky dip.
Actually, that one you mentioned last was one of the more striking ones. And if that is true to form, then date next year up, would you for a bounce?
Well, perhaps, yeah. We'll see. Any other questions? No. All right. Thank you very much.